Hey all, welcome to ShareTrekc. This is Raj here. Friends, this is a very brief video on Ginkgo Bio Q3, which reported their Q3 earnings yesterday. And here are my impressions. Let's get started. Well, friends, it's not a pretty sight. Let's finish the video here. I'm just kidding. It's not a pretty sight, but I have some things to say. We have not done a DNA video in a while, so just let's get started. And this is going to be very, very quick. There was a warning earlier. I think I mentioned even in my videos out here, and other analysts have been speaking about it, that performance-based pricing that Ginkgo announced was kind of a dampener for their revenues. And I think that is starting to manifest itself, and therefore their revenue going forward might be less. And that's what we saw in the earnings report. But before we go to the earnings report, let me just quickly take you to the price chart and then come back again. Here we are in the TradingView platform looking at the price chart for Ginkgo Bio. Each of this candle is a one-day candle. And friends, as you can see, it is one of the top losers after Invitae. Of course, Invitae, we saw the earnings report. I think I made the video yesterday. And they didn't do very well. And this was more than anticipated, 38% drop for Invitae. But now look at DNA. DNA has dropped around 15% already. And since it announced its performance-based pricing, I think the share price has fallen steadily. And things are looking bleak, in my opinion, because we are coming very close to the dollar and sub-dollar price range. So I have around maybe 2,600 shares of DNA. I'm just going to hold it for a while and see what happens. But this performance-based pricing doesn't seem to be a great idea. In performance-based pricing, what happens is that the risk of the project is totally borne by Ginkgo Bio, and the client pays only when there is success. So it's kind of a difficult situation for DNA to be in. And my hypothesis is that they probably are doing this because it's becoming difficult to sell their services. And therefore, in order to make it more attractive to potential buyers, this is what they seem to be doing. And the revenue that they generated in the biosecurity segment was having a good profit margin of around 62%. And I think despite the decline, Ginkgo has raised its expectations for biosecurity revenue up to $110 million in 2023. So this year, by the time we close out on the fourth quarter, we should have at least $110 million from biosecurity. And I think that's a good area for Ginkgo Bio because with all the pandemics coming in, and the potential for safeguarding the crops and animals and livestock, I think this is going to spread from country to country, and already Ginkgo has signed up a whole lot of countries for biosecurity. So I'm still hopeful for that. But at the end of the day, it's all a question of what kind of EPS you generate. Overall, the Q3 revenue fell 16.5% year over year to 55 million due to an expected ramp down of K12 testing in Ginkgo's biosecurity segment. Loss from operations narrowed from 655 million last year to 286 million, but EPS of minus 0.16 missed Wall Street estimates. And that's a huge miss when it comes to what was expected from Ginkgo Bio. I'll just take you back to the TradingView platform to show you how much they missed. Here you will see that the street was expecting a loss of minus 0.09 cents, and they came in with a loss of minus 0.16 cents. So it was a 75% underperformance on EPS. And friends, as I say, EPS is very, very sensitive for the market. When a company performs so poorly on EPS, I mean, it's going to be punished. So even though it has dropped 15%, I think there is more punishment in line for DNA. We'll have to see how it goes. In terms of revenue, they have done 15% better than expected. The street was estimating a revenue of 48.075 million. Instead, they made 55.43 million. Going forward, DNA is expecting total revenue of 250 million for the year, and compared to 245 million in the previous year. So there is a slight upgrade in their projections, and hopefully they would be able to meet that. But more important is the EPS than revenue. Adjusted EBITDA loss widened from 72 million in the prior year quarter, same quarter in the previous year, to 84 million, driven by both the higher run rate of expenses in the cell engineering segment and the as expected decline in biosecurity revenue as the pandemic fades. So overall, the results are not looking like a pretty picture. And then we have the news that another organization has had an alliance with Ginkgo Bioworks. It's a company called Foremost Farms, which will leverage Ginkgo's bioproduction services to develop and commercialize a new technology that could help upcycle billions of pounds of dairy co-products each year. Foremost Farms has selected Ginkgo as the partner of choice to develop a new upscaling technology because of Ginkgo's leading metabolic engineering and analytical capabilities, which will allow strain optimization for challenging environmental conditions while avoiding common toxicity issues. Again, the carbon footprint is another issue out here. But I think one of the most telling parts of this particular deal is that there is a paragraph in the press release that indicates that this is also performance-based pricing. So unless Ginkgo Bioworks succeeds in meeting the performance requirements and delivering the strain that is required to the parameters, I don't think they will get paid. So again, it's taking the risk of the entire industry onto Ginkgo Bioworks. And if they were in a position of strength, they would have been able to export these risk back to the client. So right now, it's very attractive for the clients to sign up with Ginkgo Bioworks. So selling becomes a bit easy for Ginkgo. But on the other hand, execution becomes very risky because despite all the optimization of the strain and everything, if they are not able to deliver the desired results, they don't get paid anything. So all their expenses are in vain. So we have to carefully watch how the EPS turns out in the next quarter. And one of my major worry with Ginkgo Bioworks is that the share price is so low right now. It's very close to $1. It's just a matter of time before it could potentially become sub-$1. So then they will get a notice from NASDAQ and things will start looking much worse. So that's my major fear. I'm very, very optimistic for Ginkgo Bioworks. I don't know what is wrong with this company. They have been growing very, very aggressively. They need to stop, consolidate, and start making proper margins before looking at any further growth, or else the company is going to be too unwieldy. I've been saying this for the last almost a year or so, that they need to stop the expansion, start consolidating, realize the economy of the synergies of all the acquisitions that they have had, rationalize their staffing and capital equipment and real estate and everything, so that they can be more profitable and they would have a better chance in the stock market, or else this company is looking to be in a very difficult position, especially with the high interest regime that we have around. So despite all the hype around Ginkgo Bioworks, I'm starting to get a bit concerned as they approach the dollar price. So with that, my friends, I'd like to bring this video to an end. And I think I'll catch up with you again with the next earnings report for the next company in our watch list. Bye for now.